We've got the market. Now we're getting a little bit more information and some possible tradable information. You see that the market held the 786 level. This, in my opinion, is a make or break point when it comes to Fibonacci ratios. If the market breaks below a 786, it's a pretty bearish move, and that's where I'll start looking for shorts. But we can see that it held it. In fact, it only got down there on one spike. Now the market is holding the 618. So now we're getting some pattern-based information that we can use to make a trading decision. So now at this point, we could look for the market to break back above the 618 before we're looking for a trade. We could wait for the market to recover back above the resistance area here in order to make a trade. Now remember, if we're going to buy, we have to think that we're going to be able to sell to somebody else at a higher price in order to make a profit. So we have to have some kind of logical reason to think that the market is going to trade higher. By seeing that, number one, the market is in a logical point, so that's number one, logical point, and two, that we have a pattern. When you have these two things lining up in your favor, this is when you really start stacking the odds in your favor. And you start giving yourself a verifiable edge to trade with, because you have a foundation for why the market's going to go higher. Remember, the market doesn't go higher because of MACD. The market doesn't go higher because of a stochastic. The market goes higher because market players, specifically the big money, trading syndicate money, institutional money, commercial money, bank money, thinks that price should be higher. So that thinking is going to display itself in price. It's going to display itself in price because we're looking at an area where the market has stopped in the past, and it's going to display itself in price because we're going to see familiar patterns crop up. So now we can narrow it down, and we can start developing an opinion, and we can have a couple of breakpoints. You can trade on even a 3-bar reversal. That was a very common tactic of mine when I was trading stocks. Simply counting back 1, 2, 3 bars. Actually, now that this bar is closed, I would count here 1, 2, 3, and I would look to go long above that high. And you can see that the market does break. Now, of course, if you're looking for a Fibonacci break, you could trade above that. If you're looking for a break above resistance, you could trade that as well. So it is a process of thinking. And you've got to make sure that you have the right thinking. That's going to be critical for you to move forward. And that's why on my blog I have a series of videos that I'm posting on my latest CD series on how to think like a professional trader. What do professional traders think about? What do they look for? Now, remember, it's not a course designed to turn you into a big-time commercial trader. You've got to have a lot of money to do that. But what it will do is it will clue you into the things that professional traders, syndicate traders do, what market makers do, like banks, in order to move big chunks of inventory, whether it's pounds, whether it's IBM stock, whether it's soybean oil. It doesn't matter what the inventory is. There are certain things that big-time traders have to do. And unless they do them, they're going to have a difficult time executing their orders. So I encourage you to go to the blog, check out that video. I'm going to put some more information out about the CD series itself, probably in the next coming week or so. But that video series will help you to define areas like this very quickly and very accurately, so you have a logical foundation for your trades. Remember, indicators are great, and indicators do work, but unless the market has a valid reason for going up, I don't care what the MACD says. If the MACD could be throwing off the king of all signals, But if the professional money is not behind the move, you're going to have a very small move at best, if not a continuation move, where market trading gets very fast. It gets very difficult for you to react because your emotions come into play very quickly because you're in the wrong direction and the market's moving very fast. So check out the blog for the third video. If you haven't had a chance to, go back and check out the last couple of weeks where I've posted 2 other videos in the series. And keep your eye on your email box in the next coming week for more information on that series.